profitability. In this video, you will learn exactly how to use order flow to read the market successfully. As always, to show your support, hit the like button and subscribe to the channel. It goes a long way for the team. Throughout this video, there will be a number of chapters to explain everything accurately. These chapters can be seen as the following. Chapter 1. What is order flow? Chapter 2. How to read the order flow. Chapter 3. Expectational order flow. Chapter 4. Fractals, expansion and contraction. Chapter 5. How to use order flow to get into a profitable trade. Order flow can be understood simply as the flow of buy or sell orders appearing in the market. We use the higher time frame to build our understanding because this is where the banks most actively pre-plan price action ahead of time. Yes, you heard me. The direction of the market and how it gets there is already mapped out by the algorithm that controls the money from the banks. Therefore, understanding this concept is critical for your success as a trader. Order flow can be understood as the external swing points of market structure that trends up or down. Order flow is subjective to the time frame, so in reality, every time frame has its own order flow. However, we use the 4-hour time frame to understand our order flow, as we know this is the time frame that gives us the best understanding of the bank's plan and fits the best into the strategy that we have built. It is the banks who are controlling this overall direction for price, and whatever the expectational order flow is will give us the understanding of where the market is heading. This also helps us with the live price action, because what is happening in this moment will always be in relation to the order flow. Therefore, knowing the order flow is our absolute foundation. Knowing where we are now in relation to where we are going is the most important part of a successful trade, and this is why order flow is a key component to understanding smart money. So to summarize, order flow is the overall direction of the market influenced by the banks and can be seen as the external swing points. Which leads us into Chapter 2, how to read the order flow. Chapter 2, how to read order flow. Order flow can be identified as the external swing points of the market. These swing points will have an established trend, and the direction of that trend is going to tell us what direction the banks want to take the market. What are external swing points and how to identify them? Step 1. Go to a higher time frame, 4-hour or above. We do this because the higher the time frame, the more accurate the analysis of order flow. This is because banks plan their objectives on the higher time frames. Step 2. Zoom out so you have a broader perspective of price as a whole. To mark out our swing points, we need to zoom out. You can see now that we have a broader perspective view of the order flow. We need to zoom out to see the expectational order flow accurately. Step 3. Mark out the edges of price that produce reversals. You can see here that price reverses from this point and puts in a new low from here. It reverses again and puts in a lower high. This new high is lower than the previous one. From here, we expand again back down to put in a lower low. The new low is lower than the previous one. You can now see from the reversal points, we have marked out that these are your swing points, and these are the points we use to establish our order flow. If the swings are getting lower and lower each time, then the expectational order flow is bearish. If your swing points are getting higher and higher each time, this is called bullish expectational order flow. To summarize, external swing points are what make up the order flow. You can identify them as the edges of price from where we have reversed. By marking out these swing points, you will see the direction it is trending and also where you currently are in relation to that intention. Chapter 3. Expectational order flow. A bearish example. Following on from the last chapter, we can see that each swing point gradually gets lower and lower. This is a result of the overload in supply orders from the banks and is called bearish order flow. When a swing low breaks the previous swing low, this is called a break of structure, and at some point we will have a reversal. The reversal can be seen as an internal break of structure. The high that put in the low has now been broken internally. This puts the internal trend bullish, which is why we know it is time for a pullback. The reversal occurs for two reasons. One, the banks can induce liquidity, meaning manipulating people into thinking that price is shifting. Two, it comes back up to collect all of the pending orders that are resting at certain order blocks and will start to reverse again from one of these order blocks. This reversal point will be lower than the previous high, labeling it as a lower high. You will notice the reversal as price stops increasing, shifts, and has an internal break of structure down. This is the clear confirmation that the next swing low is coming, and this gets partnered with an order block from the banks to confirm it. Price will 9 times out of 10 reverse from an order block. Now we have established that the order flow is bearish, we are already expecting price to put in a new lower low. This is called expectational order flow. So to summarize, bearish order flow is when we see our swing points gradually getting lower and lower. When price breaks a previous low, then fails to break the last high, then starts reversing, we expect price to go and put in a new lower low. This reversal is highly likely to come from an order block. Now let's go over a bullish order flow example. On the opposite side, we can see that each swing point gradually gets higher and higher. This is a result of the overload in demand orders from the banks and is called bullish order flow. When a swing high breaks the previous swing high, this is a break of structure, and at some point we will have a reversal. The reversal can be seen as an internal break of structure. The low that put in the high has now been broken internally. This puts the internal trend bearish, which is why we know it is time for a pullback. The reversal occurs for the same two reasons. One, the banks can induce liquidity, so manipulating people into thinking that price is shifting. Two, it comes back down to collect all of the pending orders that are resting at certain order blocks and will start to reverse again from one of these order blocks. This reversal point will be higher than the previous low, labeling it as a higher low. You will notice the reversal as price stops decreasing, shifts, and has an internal break of structure up. This is the clear confirmation that the next swing high is coming, and this gets partnered with an order block from the banks to confirm this. Now we have established that the order flow is bullish, we are already expecting price to put in a new higher high. This is bullish expectational order flow. To summarize, bullish order flow is when we see our swing points gradually getting higher and higher. When price breaks a previous high, then fails to break the last low and starts reversing, we expect price to go and put in a new higher high. This reversal is highly likely to come from an order block. Chapter 4, Fractals, Contraction and Expansion. As we now know from the previous chapters, price can be bullish or bearish at any one time. It cannot be both, and it must be one. This is great because it's a very mechanical if this then that understanding. If bullish, then higher high. If bearish, then lower low type of scenario. So it's the same with contraction and expansion. Price can and must be either only contracting or expanding. Contraction is the pullback phase of price, when price has just made a new high or low and is now reversing, just like we spoke about in bullish and bearish order flow. Okay, so what is contraction and expansion in a bullish order flow scenario? So let's take order flow as bullish. So the external swing points are making higher highs and higher lows, as you can see here. There comes a point after a new higher high has been made that price has an internal break of structure. So just like we do with order flow, when we mark out the external swing points, we do with the current trend when we mark out the internal swing points. Internal swing points are just simply the swing points in the middle of the current swing high and low. When the internal break of structure happens, here this is our confirmation that price has started its contraction phase, also known as a pullback, to put in a higher low. Price will often go on this internal trend for some time until eventually the algorithm kicks back in with the buy orders. This is then when we start the expansion. The expansion is the next phase of price, as it is getting ready to make a new higher high. The expansion phase is confirmed the same way. Price will have an internal break of structure. Once we see this, we know that price is going to make a new swing higher high. So to summarize, when there is a bearish internal break of structure in bullish external structure, this is the beginning of the contraction as price heads to make a higher low. At some point, the internal will have another break of structure, this time a bullish one. This is the start of the expansion phase as price gets ready to go and make a new higher high. How do I read contraction and expansion in a bearish order flow scenario? So let's take order flow as bearish. The external swing points are making lower highs and lower lows, as you can see here. There comes a point after a new lower low has been made that price has an internal break of structure up. So just like we do with order flow, when we mark out the external swing points, we do with current trend when we mark out the internal swing points. When the internal break of structure happens, here, this is our confirmation that price has started its contraction phase, also known as a pullback, to put in a lower high. Price will often go on this internal trend for some time until eventually the algorithm kicks back in with the sell orders. This is when we start the expansion phase. Almost always this expansion will come from some kind of an order block. The expansion is the next phase of price as it is getting ready to make a new lower low. The expansion phase is confirmed the same way. Price will have an internal break of structure down. Once we see this, we know that price is going to make a new swing lower low from here. So to summarize, when there is a bullish internal break of structure in bearish external structure, this is the beginning of the contraction as price heads to make a lower high. At some point, the internal will have another break of structure, this time a bearish one, likely from an order block, and this is the start of the expansion phase as price gets ready to go and make a new lower low. Now, for the most important part. Chapter 5. How to use the order flow to get into a profitable trade. Here I'm going to go over two different versions of shorts. Starting with number 1. Step 1. We need to identify our swing points to establish the direction of the order flow. First, we mark out our swing low. Then we mark out our swing high. We can see our next swing low is lower than the previous one, so we know order flow is bearish. Our next swing high is a lower high. Then our next swing low is a lower low. So we have established order flow is bearish, and now should be expecting some sort of lower high and then a new lower low as order flow is bearish. Step 2. Are we contracting or expanding? We want to be getting involved and be in a trade when the expansion phase occurs. To know this, we first need to determine the internal swing points. Let's start with this low and this high. Here is our lower low, followed by a lower high, then a new lower low, a lower high, a lower low, a lower high, and a lower low. Now, the next is a higher high. Break of structure in the opposite direction. This means the contraction has started, and we have not yet broke structure again down, so we are still in contraction. Excellent. Now we need to figure out where are we getting in the trade. Step 3. Where do we take our trade from? Step 1. Where is the liquidity? This is a concept we will explore in depth in later videos, or if you're watching this at a later date, we may have another video explaining this. Here we can clearly see we have trendline liquidity. Therefore, we want to stay away from this area, as this is an area there are likely to be other people's stop losses. Step 2, where is our order block? We can identify the area of price that initiated the sell orders, or even simpler, where did the volume come from? Here we can see we had a range, and then all of a sudden, a large momentum. So we just take the candle that started this momentum and lead to a break of structure. This is where we are going to place our first entry, at the start of this zone with our stop loss slightly above. We are going to be targeting the week low, as we already expecting price to make a lower low. And there you have it, full take profit. Just simply knowing how to read the order flow and applying order blocks and liquidity. Now, let's move on to example number 2. Example number 2. I'm just going to pull back price action quickly to our first entry, and I want to show you something very interesting. You see when price taps into the order block here, it has a reaction that causes a break of structure internally. This is our confirmation that the order block is strong, and also that we can expect the new swing low now as the expansion phase has begun. This is called the confirmation entry model. We're going to place our second order here at this new order block. That is original zone the momentum came from that broke the internal structure. With our entry at the start of the zone and stop loss slightly above the high, we can target the swing low just like the first trade for a 1 to 10 risk to reward. You can see here just how accurately this order block holds. And as price goes on all the way to hit our take profits, this is confirmation that order blocks are this powerful. This is not some made up stuff like support and resistance, it's actually predictable. If you want access to more exclusive content that will never be released to YouTube, head on over to the link in the description.